World shares have fallen overnight after a surprise move by Germany to restrict short selling.
Economic forecaster Gail Fosler is the president of the Gail Fosler Group advisory organisation, and she's in Australia with the US Studies Centre at the University of Sydney, and she joins us now. Gail Fosler, good morning. Thanks for joining us.
Good morning.
Good morning.
Market's still incredibly jittery out there.
Yes, well, you know, we've gone through about a year with markets kind of running ahead of the economy. And now I think, you know, actually the U.S. economy looks pretty good, but markets are pulling back because of all of this financial fear.
Just on the US economy, we have news overnight from the minutes of the latest FOMC board meeting. That's the group within the Fed that sets interest rates, of course, pointing to a much sharper than expected rise in economic growth to about 4%. What's your reading of where the world's largest economy is going? Will it pick up pace as the year goes on?
I think the U.S. is still extremely unsettled. I mean, the consumer is a very important part of the U.S. The consumer confidence numbers are still extremely low. And actually, consumers are very concerned for the first time, really, in the history of the Conference Board's Consumer Confidence Index about their future income. So, you know, we are not in a happy place.
That's tied to, you've always got an unemployment rate hovering around the 10%
well,
level.
it's tied to the unemployment rate, but it's also consumers are looking at the housing market. You know, wages have been very weak in the U.S. for a very long time, and actually it's asset prices that have made people feel better. Now, of course, those asset prices are weak, the unemployment rate is high, and people are looking at their futures and feeling quite concerned.
But you were saying just a moment ago that fundamentally the US economy is much better.
Well, I think we have a balance sheet recession. We have a balance sheet crisis around the world. That's what we see going on in Europe. And a lot of the adjustment we saw in the manufacturing sector was an over-adjustment to those concerns.
Right.
So manufacturing sector is picking up, investment is picking up, shops are being restocked. Even a little bit of improvement in unemployment, but we still got almost a 10% unemployment rate, and consumers are the ones who've really been battered by this recession.
Looking at the still shaky situation in Europe, and a close colleague of yours on the conference board, Paul Volcker, a former chairman of the Fed, as you know, has said he fears the problems gripping Greece and other countries could lead to the disintegration of the euro.
Right.
Do you believe that's a real prospect?
You know, that's a question I've been asked frequently since I've been here, and Paul is a very close friend, and he has worked very closely with the conference board. And I think from the inside of a policymaker looking out, that may be a genuine concern. But there's really no option for the euro. I mean, in fact, look at the struggles that the euro is having against some of these derivatives-based attacks. Smaller currencies actually can be under greater pressure. So this is not something that is rolled back. I think Europe has to roll forward to a new political union.
In what way, a new political union? How would that work?
Well, you know, it's very interesting that Europe had a whole set of stages of moving toward a an economic union.
Yes.
And, you know, the euro was kind of the final step in those stages. But when it got to the euro, it kind of declared victory, and really nothing else has happened. The constitution failed, and there's no sort of central fiscal body in Europe like there is in the U.S. to be able to manage the fiscal state of the states, or even to provide grants on a temporary basis. So Europe is going to have to tackle some tough political issues.
A lot of economists, a lot of bearish economists are likening Greece to Lehman Brothers, saying it's going to be the catalyst for the GFC Mark II.
Clearly not too big to fail.
No, not too big to fail.
Well, that's one of the problems with too big to fail. If you think about Lehman Brothers, it's actually the little brothers in the family that can get you into the biggest trouble. You know, the financial crisis was a massive liquidity crisis, where the entire system came to a halt because nobody was willing to trade with anybody else. What Greece does is it suggests that there is credit risk out there. Well, the way I describe this is we all have balance sheets, and the income side of the asset side of our balance sheet is based on what we think the value of those assets are. And Greece is just a little reminder that balance sheet is still under attack.
And just finally then, how do you account for the fact that Australia seems to have sailed through this so well?
You know, it's really nice to be here in Australia. It has problems of growth and rising interest rates and things like that.
Yeah, problems that you might want to have.
I think that macroeconomic management has actually been very, very good here in Australia. I think, although the high interest rates are always frustrating, that they have meant that Australia has had reasonable hurdle rates that have kind of kept things under control. And obviously resources are still a big sector, and that's core to Australia.
But are we relying too heavily on the resource sector?
I think that
we present ourselves to the world as a quarry, and that's kind of it.
Yeah, I think that is actually, going back to my balance sheet analogy, I think that every asset that has done well has to be skeptical about, especially assets that have been driven by financial forces, and commodities have.
Yeah.
You have to be skeptical of those values, just as we turned out to have to be skeptical about housing values in the U.S.
Gail Fosler, good to meet you. Thanks so much.
Great, thank you.
Thank
for
you.
having me.
Thank you.